A lot of investors believe that dividend stocks are the safest way to build a retirement income stream. But if you rely on dividend stocks alone, you could be adding risks that many people don't consider. If you're building your retirement portfolio and trying to figure out if dividend stocks alone can support your lifestyle, let's have that conversation. I'm going to discuss what dividends are, how do you turn them into a retirement strategy, and when they may or may not be the strategy for you. So, what is a dividend? A dividend is a share of a company's revenue paid out to its shareholders. Okay, what does that mean? Well, in the real world, we buy shares of stock, and if that's a profitable company, you're a part owner. So you get to receive a portion of that revenue if the company decides to distribute that to its shareholders. So when you own dividend paying stocks, you could receive dividend payouts, cash payouts, or maybe reinvestment options. Now, these are all different uses of when you receive that revenue from that company, how do you want to use that? So maybe you're going to spend it as a cash to benefit. Maybe you're going to reinvest it and buy more of that same stock to then continue to build up your future income. These are options that you have when purchasing dividend paying stocks. So most companies that issue dividend paying stocks are very mature companies. They've been around for a long period of time. They're very stable in their industries. Now there's some pros and cons to this. You're not going to see a company that's going to have their stock price shoot through the moon because again, they're a very stable company. So you're thinking about companies that have been around for a while. You're not seeing a whole lot of stock movement. That's not the reason we buy dividend paying companies. We want to buy those shares because they have revenues that they're paying out to their shareholders. That's a distinct difference that I think many people don't understand when they're making investment decisions. Are you buying a company stock for the dividend and the income they're sharing with their shareholders? Or are you buying a company stock because you think it's going to go up in value and then you're going to sell it down the road? That is not necessarily a dividend paying company. So distinguishing between the two when you're making your investment decision is critical when evaluating this strategy. Now, how do dividends work as a retirement strategy? Well, let's just say you have $1 million of company stock. Well, that company could say, we're paying a 3% dividend. Well, that means that off of that $1 million of share that you own, you are going to receive 3% or $30,000 a year from owning that stock. Now, that stock price, because it's a mature company, is probably not going to go up or down. So hopefully your $1 million stays at around that same value, and hopefully then your $30,000 a year stays around that same value as well. But we're not seeing a whole lot of increase in dividends dramatically, and a lot of times companies are not increasing their dividend at the same rate that maybe inflation or your spending habits are. So going all in on this strategy may or may not suit your specific needs. Another thing to keep in mind when it comes to dividends is they're not guaranteed. A company may or may not issue dividends at all one year, or they may issue a different amount. Maybe they were doing really, really well, and we've seen a lot of changes in the economy and the world over the last, let's call it 5 or 10 years, that certain companies aren't as profitable as maybe they used to be. There's some long-standing dividend-paying companies that are nowhere near the leaders in their industry anymore. So it may not always be the same companies that you own for your dividend strategy. Now to go over some basic pros of a dividend strategy. The first thing is you're buying a mature company. Chances are that company's stock price is not going to fluctuate all that much, and it's probably not going to disappear overnight. So there's comfort in owning shares of a well-established company. The second is going to be stable dividends. If a company is consistently profitable, they most likely will continue to pay out the dividends because they understand that investors want to buy their shares for their dividends. So they almost feel like that's a responsibility on the profitability of the company to continue to deliver those dividends to their investors. Now, some cons when it comes to owning dividend paying stocks. There's something called concentration risk. This is essentially of if you have $1 million and your entire portfolio is invested in one stock, you and I both know that's probably not good from a diversification standpoint. But I see a lot of investors accumulate a lot of shares and a large percentage of their portfolio in one company. Even though that company may seem very stable and they're paying consistent dividends, there's always a chance that something could disrupt that industry and cause that company's value to depreciate. And you don't want your $1 million portfolio to all of a sudden drop to 800,000, 700,000 because we as consumers don't deem that company as as valuable as it used to be the last couple of decades. Another con that a lot of times I see is dividend companies, again, don't have their share price accumulate all that much. So you actually have opportunity cost by having your money parked in that dividend paying company, as opposed to investing those same dollars potentially in a growth company whose share price is maybe on its way up through the moon. So you want to understand, what are you giving up at the same time of what are you gaining by buying into dividend paying stocks? So last thing I'll leave with is a real life example. You have $1 million portfolio, and let's say it's split among 5 different companies. Well, maybe together those companies are paying, let's say, a 4% dividend combined. Well, that's your $1 million paying out 4% would be $40,000 a year. Combined with, let's say, you and your partner's Social Security, maybe that's sufficient in order to cover your expenses. So now you just have to make sure that those dividends from those companies are staying consistent, and you're keeping an eye on those bucket of shares to make sure that they consistently are paying dividends. You're paying attention to their earnings calls, making sure that if their dividends are going to change at all, you're aware of that before they happen. Now, that could be something that you put on somebody like myself's shoulders as an asset manager to keep an eye on those portfolios for you and update you. Or it could be something that some investors do on their own, and then they take the responsibility of managing those shares and making sure that those dividends are going to be paid out as they planned. So if you're somebody who's considering building out their retirement plan, utilizing the stock dividend strategy, reach out, schedule some time with me, use the link below, and let's discuss if that strategy makes sense for you. Because again, it may be adding some certain risks that you hadn't considered. And usually what I found is combining this strategy with others makes the best and most optimal retirement income strategy. To wrap things up, if you're somebody who's considering this stock dividend strategy, reach out and use the link below. This is what I'm here for. I love to put together strategies and retirement income plans for individuals just like yourself. But chances are you're probably going to end up being like the majority of my clients, which combining this strategy with others creates the most optimal retirement income strategy for you.